We're going to talk about market update today. So there's been a lot, and a lot is an understatement of things going on in the market over the last 6 months, 9 months, 18 months. We've seen just a huge increase in volatility. So I'm excited to share some of that with you. Remember, this is a live webinar. So if you have questions at the bottom of your screen, you'll see a Q&A button. And feel free to type in any questions. I have Jenna Tranel, the president of the Tranel Financial Group, on here with us as well. And she'll be able to answer and facilitate any of those questions and get them over to me so we can get you some clarity to those questions that you have. So with that, let's get started here. So my name is Tyler Braun. I'm the Director of Financial Planning with the Tranel Financial Group. And we're here to talk everything market related today. So first, I always like starting with an agenda. We're going to cover 4 different items. We're going to go through where we are now, where the markets are at. We're going to talk about what's going on and put it into bullet point form for you. We're going to look ahead, right? What things do we need to be aware of that are coming up in the near term, intermediate term, and then long term. And then obviously we want to talk about what opportunities are available out there that we can be looking at and making sure that you, as the clients, are taking advantage of. So let's get started here. So the phrase, and you may have seen this on previous webinars, but I love this, with change and volatility comes opportunity. That's the lens that I need you looking through. So as you're hearing these different slides and we're going through these in detail, I need you to keep in mind with volatility and with change can come opportunity. And we want to make sure that we're taking advantage of that. So what's going on? Let's touch on this. So as you can see listed below, interest rates have been a huge talking point, and they'll continue to be a talking point. We're going to talk about some of that today. They continue to increase. Now they're increasing slower, but they continue to go up. We have a multitude of unrest in the world. We continue to hear about the Russia-Ukraine issues that are taking place. The United States continues to send a large amount of funds to Ukraine to help aid them in combat, and that puts a strain on some of our budgetary issues here in the U.S. And then you start to hear about North Korea and some of these other players. There's a lot of world unrest that's out there. One of the key talking points you hear about in the news quite a bit right now is a governmental shutdown slash how are they going to curb some of their spending going forward. It's a big piece. And then we're going to touch on those opportunities. So those will be the talking points for today. And just a reminder, if you have questions, please put them through to the Q&A section below, and we'll also address those at the end. So I always like seeing where we're at currently. So the best way to describe the markets this year is a tale of 2 stories. So if you look at it and you take the S&P, for example, and what you see on the screen here is the S&P 500. Year to date, the S&P 500 is up 12.44%. So you would look at that and you would say, well, that's a good return, a good solid return. Last year, the S&P was down a little over 18%. Year to date, it's up 12.44%. But when you actually peel back the layers of the onion, there's 10 sectors that make up the S&P 500. So for example, financials is a sector, technology, pharmaceuticals, utilities and energy, etc. There's 10 sectors that make up the S&P 500. And of those 10 sectors right now, only one is positive. So think about that. You're seeing a market index that's positive for the year, but only one of the 10 sectors is actually up year to date, and that's technology. And technology was heavily oversold last year. So it has not recovered. It's just trying to rebound to get close to where it once was. And it still has a ways to go. So the reason I bring this up is, if you just watch the news, for example, they would show this and say, hey, the market's up 12.44% year to date, but no one likes going back to where the volatility started. And if we look at that piece, right, the volatility really kicked in at the end of 2021, beginning of 2022. And since that time period, you can see the dip we had in 2022 and a bit of a recovery here in 2023, but the market is still down almost 10% from where it was at its high point at the beginning of 2022. So if we back it out about 18 months, even with a 12% uptick in the S&P, market's still down almost 10%. Now, a lot of you might be asking yourself the question, okay, why am I going through this and showing that other than just to give you statistics? But it's really to educate you on two terms. And this is what is so important. And I honestly believe that financial gurus and the media and so forth do a really horrific job of explaining this. Okay. There's what's called real return, and there's what's called average return. So, for example, let's say that you started with $1 million in an account. Okay, $1 million in an account, and you lost 50%. Let's say the market was way down and it was down 50%. Your million would have turned into 500,000. Correct, right? 50% reduction of $1 million equals 500,000. Well, in year two, if your portfolio was up 50%, you're gaining 50% of a smaller number. You're only back to $750,000 when you started with $1 million. But what's your average return? On paper, you were down 50% one year, up 50% the next. Your average return is what? Is zero. But what's your real return? You gained 50% of a smaller number. Your real return is negative 25%. You're still 25% below where you started. This is real life. This is where investors get frustrated because they go through this whipsaw, and on paper, they're looking at the returns of the market and they're saying, well, that was up 10% or 12%. That's an average return, not a real return. And that's something we always have to calculate. So let's give you a real life example of what this looks like. So for example, let's look at a company like Amazon. Amazon's a great institution, large company. I'm sure everyone or almost everyone on this call right now utilizes them as a company. You can see year to date, Amazon's up 49.13%. They've had a fantastic uptick, right, year to date. Last year, Amazon was negative 54%. So if they're down 54% one year and they're up 49% the next, right, their average return doesn't look too bad whatsoever. But when you put that to dollars and cents, you can see that since the volatility started, Amazon is still down almost 31% from where it started. So think about it. They started with a share price at approximately $183 in November of 2021. They dipped all the way down to about $90 per share. But the 42 or 45% upside I just showed you year to date, remember, is off of a substantially smaller number. So even though it's showing a 42% recovery, they're still down 31% from where they once were. So you might ask yourself, okay, why am I sharing this with you? I'm sharing this with you so you can educate yourself that not all investments are created equal. An average return, right, is not nearly as important as the real return that you see. So risk mitigation is key, because if you're down exponentially, right, if you're down 50% in an account, you need to get 100% return just to get back to where you were. So if we go to that previous slide, right, you think about it, you're down 50%, you need 100% return on 500,000 just to get back to $1 million. So risk mitigation becomes very important during times of volatility, as does dollar cost averaging and continue to fund accounts, et cetera, to acquire more shares at a lower price. We'll talk through some of those strategies here in just a minute. So inflation is the next piece that we're going to touch on. Okay, inflation is starting to come down. So you can see on the right side of the screen here, these are the true numbers on the CPI, the Consumer Price Index, and you can see all the items that are listed inside of this. Okay, you can see the spike that had occurred right after the pandemic. And I put to the footnotes here, inflation, we've done webinars on this, but inflation was really caused by the stimulus that we infused into the economy after the pandemic. We printed over $4 trillion of economic aid as a country. Both Republicans and Democrats did this. So it was the country as a whole. We printed over $4 trillion of economic aid, and we put it in the hands of consumers. So what's happened is the consumers started to receive these funds. It was a surplus of cash flow. Think about it. During the pandemic, you didn't travel, you weren't going anywhere, you had cash flow coming in. You might have gotten one or two stimulus checks. The average person that didn't and still doesn't have to repay their student loans at this point because they're in forbearance saved an average of over $500 a month. That they saved it in the beginning, and then they started to spend it. They got used to having that extra cash flow and they spent it. And then you add on top of that, we had labor shortages. We had supply chain issues. We couldn't import products. We couldn't ship products from one point to another. You'd go to the store, there's nothing on the shelf. That starts to go into the supply and demand piece, right? There's a huge need or demand for people to buy things because they have the cash flow and want to buy them, but there's no supply of the product, so the cost of the product has to increase. So as we look at that, we had pent-up demand. We had this influx of cash flow that was given directly to the consumer. And then we had really low interest rates. So it incentivized people to go buy because inflation historically had been low the last decade. Hey, if you can buy a 30-year fixed mortgage at 2.5%, right? What a great interest rate. So you add all these pieces together, and inflation is a sign that the economy is overheating. People were spending, and the supply chain could not keep up with it. So as we look at that, that is the spike that we saw after the pandemic of inflation, where it had really peaked out in July of roughly 2022. So July of last year. Since that time period, what the Federal Reserve does to combat inflation is they start rapidly increasing interest rates. So this is over the last decade of interest rates. And you can see we have been in a historically low interest rate environment. And you think about it, 07, 08 occurred. After 2007, 2008, the Federal Reserve cut interest rates because if you're paying less interest, right, you have more cash flow left over. Think about it. If you're buying a mortgage or buying a home and you're paying less interest, it costs you less money. You have to pay the bank. You can either afford more home or you have extra cash flow that you can in turn spend. Same thing for businesses. If businesses are paying less interest on their debt that they have or loans that are out there, or they pay less interest on a line of credit to acquire merchandise, they have higher profit margins. And that profit margin can either be taxed or it can in turn reward shareholders. And those shareholders have more in their 401k and so forth. So interest rates have been historically low. We started to see an increase in rates all the way back to 2018 through 2020. And then we saw the pandemic hit and the Federal Reserve cut rates literally to zero. They were 0.001. The federal funds rate was nothing. They had actually talked at one point about having negative interest rates. So we kept those low. And then all of a sudden, the Federal Reserve started utilizing the word inflation is going to be transient. And I want you to think back, right? That was a term that was used a lot. Transient means temporary. I don't know why they just can't call it temporary, right? They have to use these fancy words, but they called inflation transient. And they said that it would reduce automatically because it was incurred due to the pandemic, right? We saw an increase due to the pandemic. But when you put that much money into the economy, $4 trillion, it takes a heck of a lot longer than they anticipated to actually trickle through and work its way through the economy. So what I mean by that is most people think, well, if I have an extra $500 a month coming in because I haven't had to make my student loan payment, and I spend that $500 at the store, it's done, right? It's now worked its way through the economy. I got the money and I spent it and I bought something. Well, remember, if you go to the store, and let's think of a small business just for ease here. You go to the store and you want to buy something from a small business owner. You give them $500. They give you a product. They now have that $500 and they're in turn taking that profit and they're spending it. And the next person has it and they take that money that they received their profit from and they're spending it. And it has to work its way all the way through the economy. And it took a lot longer than most people anticipated because there was such a large amount of assets that had to work its way through. So long story short, we have seen the Federal Reserve ratchet up interest rates at the fastest pace in US history. So all of you on this call, you are part of history. We have just lived through the fastest increase of interest rates ever in the United States history. I don't know if that's good or bad, but that's a different conversation. In essence, what's happening is they're making things more expensive on purpose. And that sounds backwards, right? Why would we want to make things more expensive? Don't we want the economy to continue to expand and grow? Now, the answer to that question is yes, we want the economy to grow, but we don't want it to overheat. And what they're doing is they're pumping the brakes on the economy to slow spending, because if there's less demand for product, all of a sudden the supply side fills up, right? Supply and demand. If you have a huge supply of product and nobody wants to buy it, or less people want to buy it, the cost starts to come down. And that's exactly what we've been seeing. Now, I have a lot of clients that will say to me, you know what, I'm not necessarily feeling that inflation is being reflected properly, because I just showed you this previous report where inflation went from 8.2 down to roughly 3.2. That's a big drop. The reason for that being is inflation is one of those very fickle or difficult metrics. It works like a stair step. Think of anybody on here that does home remodeling or does wood projects. I want you to think of a cost of a 2x4. So previous to the pandemic, you could go to Home Depot, Lowe's, Menards, and you could buy a 2x4, an 8-foot 2x4 for probably about $1.49. And I know that because I used to do it. And then during the pandemic, just like you saw in that previous chart, the price spiked exponentially. So we went from $1.49 to the peak during the pandemic. A 2x4 cost over $9 per board. Now, what happened is that 2x4 started to come down in price exponentially. And right now, if you went to Menards or Home Depot, it's right around $3.50 per board. So what's being celebrated is it was once $9 and it decreased to $3.50. But remember, it started at $1.50. So it's still 180% higher in cost to buy that 2x4, but it's 300% cheaper than where it was at its peak. So inflation, typically when it goes up and comes down, it's stepping up to that new price, and that's going to be the new floor, and then you'll have the next increase and the next increase, right? So that's how inflation works. It sets a new floor, and then it starts growing off of that piece, and that's what we're seeing. It spiked, it has slowed and decreased, but it's still higher than where it once was. So next piece that we need to look at is this has created some opportunities. Interest rates going up have created opportunities that we haven't seen in decades, where now we can look at different types of investments that are out there, right? We can look at T-bills. We can look at money markets. We can look at some of these fixed rate products that are paying some really substantial interest for the first time really in the last 20 years, which is exciting. That's opening up some additional opportunities. I put down on the bottom, you have to pay attention to what you're investing in. So the biggest piece that people are making mistakes on is as they get closer to retirement. So if you're still working, you still have a 401k, over 80% of Americans just put into what they call age-based portfolios. So that would be an allocation that if you looked at your statement, let's say it said like Vanguard 2025 fund on it, or Vanguard 2030 fund. What that means is the closer you get to that date, the more conservative they're automatically going to start making that investment. So they're replacing your equities, because those are typically more aggressive, and they're putting more fixed income or bonds into the portfolio. So when they're doing that, right, in a normal world, normal economic world, right, that typically brings more security to the portfolio because you're removing the equity piece, which is typically more aggressive. Well, I just got done telling you that interest rates are rapidly increasing. So if my arm's a teeter-totter and interest rates go up, what do fixed income or bond prices do? They fall. They work inverse. We just went through the fastest rate increase in US history, which means these bond prices fell exponentially, and that 401k is automatically shifting you out of stocks and into bonds. So it does not work. So that's one of those pieces we have to pay attention to what we're dollar cost averaging or contributing to, because you can really get hit by being in the wrong sector in the current environment. Next piece we're going to touch on, okay? Governmental shutdown. So this is something you hear on the news quite a bit right now in particular, right? The government is set to really go into a phase where we would start to see a shutdown as early as next week. They need to have some form of agreement passed by Saturday evening. The Congress is, disputing each other right now. The House is at a point where they just rejected the Senate's bill. They're trying to do a last ditch effort to extend this out. There's a lot of bickering back and forth. You hear all these terms. There's a lot of political gamesmanship that's going on both parties right now. But I really want to touch on this. I don't want you to be scared with a governmental shutdown. Okay. This will create some short-term volatility, but it's not something that should scare you. So let's look at the statistics here. So if you think back, we just went through, I actually did a webinar on this. We just went through what they called a default conversation about roughly 2 or 3 months ago. So the end of June, they took it right down to the wire, and they were talking about a debt default. Okay, this is not a debt default. So I put that in capital letters here. This is not a default of the U.S. government. This is a shutdown of the government. We have the money to pay the bills or budgeted to pay the bills. We just can't agree upon price increases, how we're going to pay them, where it's going to come from. Our legislation, right? Our two parties are fighting, saying we're not agreeing on the budget going forward. So this is not a default of the U.S. government. They're talking about a governmental shutdown. The government has shut down 10 times in our nation's history. So think about that. We've been through this 10 different times. What blew me away is we've shut down 5 times in the last 20 years, and we've shut down 3 times since 2010, right? So you hear that, you're like, gosh, I don't really remember, those shutdowns, but this is something that has occurred in the past. The biggest takeaway is there will be a resolution at some point. It's not an if, it's a when, right? We have to have the government open in order to function. They will have what they call essential workers that will continue to work at the government. And typically what ends up happening in the playbook we've seen from the past is they're going to furlough these employees. Those employees are going to be compensated with back pay typically for the time that they missed. And it ends up costing the government even more money to get everything up and going again because of the lost revenue that we had during that time period. So there's no winner in a shutdown, but it should not scare you because as a whole, corporate America still needs to continue to function. You're still going to have people purchasing their goods. You're still going to have people going out and about. And, I'm going to take us back to the last shutdown that we went through, which was in 2019. Okay, so as I talked about before, it causes uncertainty, and uncertainty can cause short-term volatility. So if you look at my screen, this is 2019. So this is the S&P 500 in 2019. You can see when the governmental shutdown occurred, you can see the dip that occurred in the market. So as of May, it looks like the S&P was up about 17%, and it dipped about 7 percentage points down to close to 10% over the course of that month because the government was shut down for about 30 days. Now, when they came back and turned the government back on, they announced that they would be back paying the employees, etc. You saw the market not only recover, but also grow or gain during that entire next month. So if you sold here, you would have missed all this upside, and that's what we want to avoid, right? We don't let our emotions take over. But the reason I show this is you can see 2020 or 2019 was a fantastic year for the markets. The markets were up almost 30%, right? And that was with a governmental shutdown baked right into that year. So short-term volatility will be caused just because there's uncertainty and you'll have fear that comes with that. that also will have a bearing on inflation, right? One of the key factors that the government is measuring, or excuse me, the Federal Reserve is measuring with inflation is unemployment rates. They actually want to see unemployment rise because if unemployment rises, there's less people spending money, there's less demand, and inflation will come down. If the government shuts down, the government is the largest employer in the United States, you will see inflation or unemployment spike immediately because those people are now unemployed. It will obviously drop back down once they kick that back in, but it has some of the bearing on the conversation in the short term of will the Federal Reserve continue to raise interest rates or will they continue to pause or even possibly decrease them during this time? So, long story short, we could see a shutdown. Don't lose sleep over it. It will cause volatility, absolutely, because there's uncertainty. You're holding really good, solid companies, and you'll see that recovery as we've seen in historical trends. World unrest. We could talk about this for an hour. There is a lot that's going on in the world right now. So, as we talked about before, the Russia and Ukraine issues, North Korea talking with Russia, China, Taiwan, there's always going to be something. So just be aware of that. There's always going to be some kind of conflict or some type of issue happening in the world, and we cannot lose any sleep over that. Some of the pieces that you hear on the news, the de-dollarization, gold, all those pieces, we can have conversations around those and plan accordingly for it. But from a world unrest standpoint, we are so blessed that you live in the United States and be free, that it's not something that you can ever say, okay, we need to move the needle this way or that way based on some announcement that's out there. What we're doing is we're saying, hey, we're investing in really solid companies, really good companies, and as things arise, we adjust and pivot as necessary. So, for example, if the U.S. government continues to sanction Russia, and there's a corporation that has a large percentage of their revenue generated from Russia that is no longer going to have that revenue, we'd want to get out of that company, right? But we've already been making those pieces and adjustments across the board. So those are where you can turn the dial a bit, but there's always going to be something. So I don't want you losing any sleep over any of the unrest that's out there right now. So key takeaways. So number one, higher interest rates, as we talked about before, are creating opportunities we haven't seen in over 15 years. So the big piece with that, I think of a T-bill, for example. A T-bill is like a CD that's backed by the U.S. government. They're approaching 6% interest now. I mean, that's definitely something to look at. We've seen a way to mitigate some risk and get some higher yields that we haven't been able to get before, right? So I always talk to clients, if there's lazy money, and that's money that you're just parking, that you're saying, I don't want to subject to any risk, we should have a conversation because there's ways to get higher returns without taking on that higher risk. Okay. You now have the ability to look at, okay, how do we reduce some of the risk exposure for the future? And then how do we take advantage of some of this volatility? So those of you that are still working, that are on this call, right? What a great opportunity in your 401k to keep adding to it. Right? You're doing it already. Remember, there's two pieces in a 401k. There's your current holdings and there's your future contributions. Well, future contributions are money that you haven't even put into the account yet, meaning that if the market goes down, you haven't yet put money in. That's exactly when you want to buy the more aggressive holdings because you're buying at a discount. Right? And your current holdings in your 401k, yes, we want to treat those differently. We want to secure that. We want to look at different ways to compound that and grow. But your future contributions, we want to still be aggressive and use this volatility to your advantage. This is a perfect opportunity here to take advantage of that. And then we want to insulate the cash flow. So insulating cash flow is just a term that we use that says, how do we secure your income so we don't have to reduce your principal, meaning we don't have to sell shares. Or if we sell shares, we want to sell less shares. This is where people make the mistake in retirement, is they're just holding something and they're hoping that the market goes up every single month. It doesn't work like that. So what happens is all of a sudden the market's down and they have to sell 5% of something, but it's down 10%. So they're really selling the equivalent of 15% of that holding, right? You multiply your losses by harvesting your principal. We don't want that. We want an income stream off the number of shares you own. So even if it's down, you still own the same number of shares. You can continue to compound higher and you draw your income stream off it in the interim, right? You don't have to harvest principal that way. And it allows you to just continue to have a reliant income stream in retirement. So 4 pieces here that I'm going to touch on. These are opportunities that are out there. We're approaching the end of the year. Tax loss harvesting should be coming into your conversation. So we've had a lot of volatility for an individual that has, let's say, had money invested in an after-tax account. So that would be, just a normal brokerage account, individual account, joint account, trust account, something that's not an IRA. Let's say you've had money in there over the last 10 years. You would have done exceptionally well. And what that generates is those holdings that have done really, really well probably have a capital gain attached to them. Meaning if you bought a company at $50 a share and it's grown to 100, right? That $50 per share price is a gain. And when you sell it, they call that a realized gain, right? Right now it's unrealized because you haven't pulled the trigger and sold it yet. So what we look at is we say, okay, are there any holdings in the last 18 months that are trading at a loss that we could sell and harvest some of those losses and then sell some of the shares at a gain, even if we're going to buy those shares back 31 days later, and that's the key for a wash sale. I'm not going to dive down that. What we're doing is we're stepping up your cost basis to a larger number. So when you go to sell it in the future, you'll pay less tax. Or if you know there's a big distribution coming up, what a great way to free up some funds to pay for that distribution without incurring a large tax. Roth conversions. This is a huge piece. This is something that we need to be talking about if we haven't. For certain people, it makes a ton of sense. For other people, it doesn't. With volatility in play, do you want to convert a Roth? This is a question. Do you want to convert a Roth when the market's down or when the market's up? And the question or the answer to that is you want to convert it when it's down, because the advantage of a Roth is all of the gains are 100% tax-free. Wouldn't you rather convert when the market's down and have all those gains as the market comes back be tax-free versus taxable? And the answer to that is yes. So certain people, it doesn't make sense due to tax constraints or due to age. Other people, it absolutely does. Look to reallocate for the future. This is the conversation around current holdings versus future contributions in your 401k. If you're adding money to your 401k, you can still continue to be aggressive with your future contributions. Current holdings, we can be more conservative. They don't have to be the same. So we need to look at how we can take advantage of that going forward in the future. And then there's opportunities to contribute, different buckets that have less volatility. Or if you're long-term, right, buy the dips in the market, take advantage of the volatility long-term. So great opportunities that are at hand here as we dive through. So looking ahead, we do anticipate that inflation will continue to ease. We're down to roughly 3.2 on the CPI. We were as high as 8.2, so it's come down exponentially. I do anticipate that we'll continue to see that ease. Interest rates are increasing still, but it is definitely slowing down, right? We've had multiple months now where they've said, you know what, we're going to keep them as is. But the Fed is still what they call hawkish. And that's a fancy term for they're still aggressive on raising interest rates if they need to. The reason they're overly hawkish is they can't come forth and say, we're going to cut rates, because the market will jump up right away in anticipation of that. So what they're doing is they're saying, hey, we are going and willing to increase interest rates as much as needed to squish or to knock out inflation and to get back into that 2% range, which is their goal. And then the third piece is there's still a lot of uncertainty. So the best advice I can give you is stay invested in solid companies that you know are going to be there for a long time. So we focus on companies and holdings that you need the product regardless of what's occurring, right? If there's a governmental shutdown, you still got to buy food, still got to buy toilet paper, clothes, if you have kids, diapers, etc., right? Know what you're investing in and know how it works. Like I just talked about earlier with the fixed income piece, right? As interest rates rise, bond prices fall. Well, you don't want to hold those in a rising interest rate environment. But if interest rates start to fall, fixed income could be very attractive. So we just have to know that and position it properly. Make sure that assets are not only focused on the now, but also the longer term. If we're only looking at the now, we always miss opportunities for the future. Think back to your parents, right? In the home, they might have owned a home and paid $10,000 for it and said, "Oh, I'm going to wait till it goes to 8 before I buy it because it's just too high." And now that home's probably worth 3 or 4 or $500,000, right? So there's always going to be long-term opportunity that we have to pay attention to. We need to make sure that we're dollar cost averaging, meaning putting money back into the accounts that we're not taking income from. I'll do a whole webinar just on that, but how to get momentum and get one account to feed the next, and that's truly how you build wealth. And then insulate that income. And there's a term that we use a lot called dividend aristocrats, and those are companies that have increased the dividend for 25 consecutive years. They've still continued to increase dividends this year, even with the volatility. That covers your lifestyle and your income. You don't have to rely on the market going up, even though over time it does. It's one of those pieces when we look at it, you're saying, hey, I have the same number of shares. I'm able to draw my income from this, and I'm insulated from this volatility. I can wait for the market to go up. And then break down income now versus growth later. By doing that, you always have assets accruing in the background where if they're up, we take the gains off the table, shift them to the lower volatility or income generating assets, give yourself a raise, or be able to pay for those big expenses. So with that being said, that's everything that I have prepared for today. Jenna, do we have any questions that are out there at all that came through that clients would like us to go through?
We do. We have two questions that I'd like to ask. The
Okay.
first one would be, would the goal of the Fed, would the goal of the Fed be to get us to disinflate rather than deflate? And how will the ongoing war in Ukraine impact either outcome?
Okay. So the goal of the Fed is to do two things. Number one, keep the train on the tracks with the economy. And number two, control inflation. Because inflation is one of those things that impacts everyone. And what they're doing is they're making the decision saying that we have to make the hard choice and cool off the economy to drive inflation down. They're not looking to get to a deflationary agenda. They don't want to be deflationary because if it's deflationary, that's typically getting you into that recession type conversation where the economy has fallen too quickly. So what they're trying to shoot for is what's called a soft landing. A soft landing simply means that they're trying to slow the economy down by rising interest rates, get back in that 2% goal. That's their goal. They want to be in that 2 to 2.5% inflation year over year metric, and they're not far from it. And when they do that, that's when we'll see typically interest rates flatline or even start to decrease. And when they cut interest rates, if you think back to 08, 09, when they started cutting interest rates, that's when the economy starts to turn around. Things become less expensive. We start to see people take out loans, spend money, mortgages become cheaper, car loans become cheaper, etc. It starts to basically influence more for the positive on economic growth. I don't necessarily think we're going to see any dramatic decreases in interest rates over the next few years, but I do think we'll probably see them coming down a bit from their highs. But no, they're not shooting for deflation. They're shooting for getting inflation to a point where it is in that 2% range, because that's the metric of a healthy economy. And then from there, they'll gauge where they need to move interest rates going forward.
Thank you. I do appreciate that. And the last question that I have is actually about inflation as well in relation to fuel prices. So, what is the
Okay.
likelihood of fuel prices lowering as inflation eases?
Um, two different pieces. The reason I say two different pieces, that's a loaded question. Uh, Fuel prices are it goes to supply and demand, and then fuel prices are also dictated by other partners. So if you look at OPEC, for example, if we see a shortage in fuel or they reduce how much they're pumping, what happens is the fuel prices go up, right? Meaning there's less fuel available, we'll pay more. Okay, that's number one. Number two, what we look at is what we've done as a nation, as we've utilized what's called strategic oil reserves over the past 2 years, meaning that we're utilizing more of our oil that we hold on hand in our different storage facilities to flood the market with more oil to keep it artificially low. Meaning that OPEC was working against us for the past year to try and raise prices, right? They want oil to be higher because that's where they make their money. And what we're doing is we're saying, no, we want oil to be lower so it's not such an hindrance on our overall economy. So we've been putting our strategic reserves out there. The risk that we run is we need to be filling those back up in order to have strategic reserves in the future. And that's a risk that we're running is we have not filled those reserves back up to the capacity levels they were at previously. So if inflation eases, meaning that inflation as a whole starts coming down, that doesn't mean that fuel prices will come down. What can happen is actually fuel prices can lead to inflation being more persistent and here for a longer period of time. So all the other pieces can start coming down, and then all of a sudden gas prices jump to $5 a gallon, and all the savings you got because food prices cost less is now wiped out because you have to pay more at the pump. And that oil is a true driving force. That's why we want oil prices down. Oil is a double-edged sword. It costs more money to produce the product because oil is higher. It costs more money to ship the product to you, which means the product gets charged more. And then it costs you more money to go pick up the product and bring it home, which means you pay more money. So oil prices being down are actually why inflation has decreased somewhat of the way it has, and that's why the strategic oil reserves we're utilizing those to do that. But oil could spike, and it could actually cause inflation to be more persistent for the Federal Reserve. That's why they're trying to get ahead of it. I hope that wasn't too nerdy.
I loved it. Loved that response. That was a great response. Thank you for that. There are currently no more questions.
Perfect.
If anyone does have anything that they think of later as they're driving home or walking their dog or whatever it might be, please feel free to email us. We're very happy to respond and help educate from that perspective. But thank you so much, Tyler. That was very informative. And if anyone has anything else that they'd like to ask, please feel free to call us.
Sounds
Have a
great.
great day.
Appreciate it, everybody. Thanks, Jenna. Thanks, everyone. Have a good day.